Over the last couple of weeks, we've seen a pullback from the market as a whole, with the S&P 500 actually being about 3% down since the beginning of this year, as of the time that I'm recording this. And the main reason for this pullback is actually due to the Fed announcing more rate hikes going into this year than was expected due to inflation running past their expected rate. I was wrong about inflation. I really, truly, and I still to a degree believed that inflation was going to be transitory, because when you see prices of used cars being an appreciating asset, it's like, yo, all of this stuff is going to settle. But the pandemic was a lot worse than we actually expected. And energy prices just kept on skyrocketing as OPEC Plus and all these other companies decided, yo, we want to make our money that we lost in 2020. And so we're seeing prices just continue to remain at an elevated state. It seems like monetary policy doesn't have much to do with the inflation, though, because it seems wage increases and fiscal policy is the things that actually affect inflation a whole lot more than we thought. But regardless, inflation has been picking up, and so the Fed is trying to do something to fight that inflation. And so they announced that they're going to be doing some more rate hikes than they expected to do at the beginning of this year, and also going to be increasing their tapering, which is their bond repurchasing that they've been doing all throughout the pandemic all to this point. They're going to increase the slowdown rate, or they're going to drastically reduce the amount of bonds that they've been buying and actually put the brakes on so that the economy doesn't overheat too quickly due to inflation right now being at 7%, which is a 40-year high. And with that announcement, like I said, the market actually took a nice little dip. One part of the market particularly is getting absolutely slaughtered. And the best way to actually picture this is using the ARK Innovation ETF. This ETF is down almost 18% since the beginning of the year. And if we look over the last year, this thing is down almost 50% from its all-time highs. It is not looking good for a lot of the companies that were high flying and just could not be stopped during 2020 and early 2021. A lot of those companies are getting beaten down. A lot of those companies are getting destroyed. I mean, even if I look at my portfolio and look at my speculative bets portfolio, I can see you can just see I'm getting destroyed in this portfolio. With one of the biggest holdings in here being Alibaba, which is not that speculative, but still, it's just getting crushed. Like, growth companies and growth stock names are getting just absolutely wrecked. And then if we look at my growth portfolio and more speculative plays like Lemonade, it's down more than 50%. It is getting slaughtered. Another big name that I really love, CrowdStrike, is getting absolutely destroyed right now. And so the question that a lot of people have is, what are you going to do? Are you going to keep holding these companies? Are you going to keep holding on to these names? And one thing that I'm hearing a whole lot more people talk about is the rotation in the market. All the investor sentiment is changing. There's a rotation going on in the market. People are moving away from growth stocks names into more value names, into more safe positions, which in this case, all safe position means is companies that actually make a profit, companies that actually bring money in, rather than a lot of these money losing businesses like the ones that I have in the speculative portfolio. And so the question is what am I going to do? And the answer is absolutely nothing. I'm not going to do anything to change up how my portfolio looks. I'm not going to be doing anything to change up the way that I have my portfolio set up right now. The main reason for this is in investing, there's something that we have to learn earlier on. And it's something that I'm trying to learn. And it's one of my biggest goals for this year when it comes to investing, which is do less. Do less. Last year, I was buying, selling, changing up my portfolio, adding stocks, removing stocks, doing all kinds of stuff with the portfolio. And really, it did not profit me much of anything, if anything at all. And so this year, one of the key things that I'm going to be doing is to do a whole lot less. Unlike anything else, in investing, less is actually more. The harder you try, the more you try to do stuff, the more you're playing around when you're in your portfolio, the more you're buying, selling, the less and the less you actually get out of it. There's a saying that goes that you don't make money when you buy or sell a stock. You make money by holding the stock, by doing nothing. So in other words, you have to do a lot of stuff up front before you decide to add a stock into your portfolio. And so that's one of the key things that I'm going to be doing this year, is to do a whole lot less, is to do a whole lot of just waiting, sitting around. I'm still going to be dollar cost averaging into businesses that I see as good value at that point in time, but I'm not going to be adding in and taking out and adding in and I'm just doing too much. I'm just going to focus on the businesses that I've already determined to be good businesses and just keep buying into those. But there is one thing that I'm hoping that happens this year, which is I'm hoping we see more of a dramatic pullback in the S&P 500 and more of a dramatic pullback in a lot of the companies that I really like. I'm kind of hoping that we see kind of ARK Innovation ETF pullback happened with the market as a whole. The main reason for that is there are companies that I would love to own. There are companies that I would love to have a lot more of a position in. For example, Costco. Costco is one of those companies that I would love just to own more of Costco. I love the business. I love the way that they handle everything with the company. I just want to own more of it. But the company is at, I mean, if you look at the PE right now, it's sitting at a PE of 43, bigger than a lot of growth stocks right now. And so it's just kind of like, I can't justify continually buying into Costco, even though it's seeing a slight decline. But if we see a pullback in the market, honestly, I'm going to sell out of store capital to put all that money into Costco, because I really don't care about owning REITs anymore. I really don't care about learning more about real estate investment strategy. I have exposure to real estate in other ways. Stay tuned, by the way. This year is going to be an exciting one for me, but I just want to own more of a Costco. I just love the way the business is. I love the way they're growing. They're actually going to be opening. I believe Costco announced they're going to be opening like 20 new stores this year. Yeah. Costco announced that it's going to open 28 new stores this year, which is more than it usually opens in a year. And so there's just a lot of growth opportunity when it comes to Costco. And I really want to be a part of it. And then if we see a massive pullback in my lovely companies like Apple or Microsoft, your boy gonna be buying in. I will more than likely sell out of Bank of America as well and put those monies into one of these other companies. One thing, I'm trying to reduce the holdings as well. And of course, as you guys know, Jeppy is just a cash position for it to be paying me dividends while I'm waiting for a better opportunity out in the market. And so that's what I'm going to be doing this year. The goal of this year is less is more, which means there's going to be less portfolio updates. There's going to be less me talking about different stocks all the time, which is another thing that I want to be more focused in on the channel, is focusing more on personal finance, because I believe that makes much more of a difference for most people. In the year 2022, the goal for me is for me to do less, is to do a whole lot less. But anyway, that's all I got for y'all. I hope y'all learned one, maybe two things out of this entire thing. But before we close it out, just some quick updates on the portfolio as a whole. In the year 2021, I brought in a total dividend, or in December of 2021, I brought in dividends totaling $11.57 on the portfolio. And as a whole, we brought in $62.15 in dividends. Everything is moving in a very nice direction from 2020, which is the first time I opened the portfolio in March of 2020. We brought in a total dividend of $17 in 2020, and in 2021, that went all the way up to $16.15. And as you can see, it has been going up and trending in the right direction. So we love to see that as we continue to invest, as we continue to grow this money and grow this pile. We want to see that continue to get up to, hopefully this year, or get up to $100, but we'll see what happens. But anyway, that's all I got for y'all. I hope y'all learned one, maybe two things out of this entire thing. And if you did, share this video with one person that you love, one person that you hate, and one person you're just kind of like about. And by that time, you'd have shared it with every single person that you know. But I'm gonna catch y'all up on the next one. Remember, generosity is always greater than greed. God bless each and every single one of y'all, and I'm out. Peace. Whoosh.